Yo, trading family, what's up? Wednesday, July 22nd. The monitors are humming. Rockstar's cracked open. DFV. The Orange Menace is sitting on my keyboard judging my pre-market watch list. TB, you with me this morning?
I'm here. And quick disclaimer before we get rolling, nothing we say is financial advice. We're just two guys reading the tape and talking about it. Do your own research, talk to an actual advisor, all that. Floor's yours, WC.
All right, let's talk about what the tape is screaming this morning. Yesterday was a damn party. SPY up 81 basis points. The Qs up 1.84%. IWM up 141. Semis ripping, small caps catching bids. The kind of broad follow-through that makes you think earnings season is going to send us to the moon. This morning, entirely different energy. SPY futures down 32 bips. NASDAQ futures down 0.03%. VIX opening at 17.62, up 3.5%. And the headline that matters before you look at anything else, West Texas Intermediate crude oil, up 3.6% to $87.43. Brent crude touching 94 bucks. I'm not going to bury the thesis. The market has been treating the Iran conflict as headline noise for weeks. You acknowledge it, you trade through it. This morning, the bond market is telling you it's something else. 2-month high on Treasury yields. The Kevin Warsh inflation fight continues. Trade is fully repriced. 27% probability of a rate hike this month. That number was 0 2 weeks ago. The collision that defines today is the one between yesterday's earnings momentum and this morning's oil-driven repricing of inflation risk. And it's landing on the single biggest earnings night of the quarter. Tesla, Alphabet, Texas Instruments, ServiceNow. All reporting after the close. 11 straight nights of U.S. strikes on Iran. Rubio at the Ashan meeting yesterday calling out the Strait of Hormuz precedent. Houthis threatening to widen disruption. This is structural supply risk, not a one-day spike. My TFT algo is sitting on 6 positions. AXP, Bank of America, Chubb, INSEE, mostly flat to slightly red, a couple $100 of unrealized drawdown. It entered new positions at yesterday's close, riding the momentum. We'll see how they hold up if oil keeps running. But the macro shift is the real story. TB, you've been digging into the hidden debt angle for tonight's Alphabet print. I want to hear how that frames the earnings call.
Yeah, I'll get there. But first, let's zoom out on the double choke point because that's the engine driving this whole tape. It's not just Iran and Hormuz. The Houthi threat to open a second disruption point changes the math from one geopolitical headline to a pattern of supply chain weaponization. Rubio didn't just say Iran isn't serious. He said allowing a nation to control an international waterway and charge a toll sets a very dangerous precedent. That's State Department language signaling they are not backing down, and the 11th straight night of strikes proves the operations match the rhetoric. The bond market already priced this. Yields at 2-month highs, Warsh trade fully in, 27% hike probability. The equity market is still in denial. Yesterday proved that, but this morning's futures are cracking that denial. When oil stays above $90 for more than a couple sessions, the math on growth stocks changes. Higher oil means higher input costs, higher transport costs, stickier consumer prices. That keeps the Fed hawkish. That means discount rates stay elevated and growth stocks priced at 30 times forward earnings have to compress their multiples. Fundamentals don't need to change for the stock to fall. The rate backdrop does the damage.
Exactly. And the denial cracking is what makes today so dangerous. Yesterday, the market was pricing pure earnings optimism. This morning, it's repricing inflation risk, and it's doing it hours before the quarter's biggest earnings prints. That's not a backdrop. That's a collision. My personal gut call account is long. The energy sector ETF from July 15th at 56.94, sitting at 58.50 this morning. The Hormuz supply premium thesis is working. I'm not adding. Chasing at 58.50 risks turning a good entry into an average one, letting it run. But here's the second layer. The hidden debt you flagged from the Nikkei report. 5 tech firms, 1.65 trillion in off-balance sheet obligations. That changes how you listen to Alphabet tonight. The market's going to parse revenue beats and cloud growth. I want to hear if they use the word optimize. If they do, that's code for the debt is biting. If they go full speed ahead, that's margin pressure for the next 4 quarters. Either way, the CapEx language is the real tell. TB, you want to lead us into the earnings breakdown?
Let's do it. Tonight's marquee reports: Tesla ticker TSLA, Alphabet, Google, Texas Instruments, ServiceNow, NOW, and IBM, T-Mobile. T-Mobile reports tomorrow pre-market. This is the heaviest earnings night before the true Mag 7 wave kicks in. The lens I want to bring, and this is straight from the Mike Jones research, is hidden debt. That Nikkei report showed 5 U.S. tech firms carrying $1.65 trillion in off-balance sheet obligations. Meta alone, at $420 billion, tripled their reported debt. Google is one of those 5. So tonight, the revenue beat matters, the cloud growth matters, but the language around capital expenditure is the actual signal. If they talk about optimizing infrastructure spend or efficiency, that's a direct acknowledgement that the hidden leverage is constraining them. If they double down on full speed ahead spending, that's margin pressure and the debt number gets worse. Either outcome has second-order effects on the semiconductor demand picture because Google is one of the world's biggest buyers of artificial intelligence infrastructure. Texas Instruments is the industrial demand tell. Broad-based semis, not AI-specific. If Texas Instruments guides soft, the rotation thesis from Mag 7 to semis has a ceiling because non-AI industrial demand isn't there yet. ServiceNow and IBM are enterprise spend signals. If both are strong, corporate IT budgets are holding. If either disappoints, that's a crack in the demand picture we haven't seen this earnings season. Tesla is the volatility wildcard. The robo-taxi narrative has been running for weeks. Resistance at 377, and the options market is pricing a sizable move. I don't have a strong directional read, just that optimism is priced in and needs to deliver. 2 of those 4 prints disappointing, combined with oil staying elevated, and tomorrow's tape is going to feel very different.
That hidden debt framing is the sharpest angle going into tonight. Nobody's scanning transcripts for the word optimize, but they should be, and that directly connects to the macro. Higher yields make servicing all that off-balance sheet debt more expensive. So the rate backdrop and the hidden debt story are the same story. You can't separate them. Now, let's hit the economic calendar before we go further. No major US data today, but the rest of the week is loaded in a way that feeds directly into this rate path anxiety.
Yeah, let me run through it quickly. Today, UK unemployment rate, consensus 4.9%, prior 4.9. No surprise expected. The big wave comes Thursday. UK CPI data, core CP. I consensus 2.5%, down from 2.6. Headline CP, I consensus 2.7, down from 2.8. Also, PPI input and output numbers. A beat on any of those pushes rate hike fears further into the global conversation. A miss gives some relief. Then Friday, the ECB rate decision. Consensus 2.4%, no change expected, but the language on inflation is everything. Also Friday, Eurozone consumer confidence consensus minus 16.9. Japan National Core, CP, I consensus 1.6%. First read on Japan's price pressure, and if that pops, Bank of Japan tightening talk resurfaces. Saturday has UK retail sales, which won't move the US tape overnight, but sets the tone for sterling. So the global rate path tells this week are Thursday's UK CPI and Friday's ECB and Japan CPI.
Yeah, good, clean. And meanwhile, the sector board is already reflecting exactly what we're talking about. 1 week performance. The energy sector, ETF Energy, up 2.72%. Direct oil premium expression. XLRE Real Estate, up 1.62. XLV Healthcare, up 1.24. Safety bids. Laggards. XLC Communication Services down 1.27. The tech sector technology down 1.5. XLU Utilities down 1.69. Classic stagflation rotation. Money pouring into energy and defensives, fleeing long-duration growth and rate-sensitive utilities. If oil stays above 88, this rotation accelerates hard. Let's check the overnight tape so we know what's already been priced in. Asia, Nikkei, 225 down 0.18%. Hang Seng down 95 hundredths. Shanghai Composite up 1.86%. That counter-trend rally will get ignored by the US tape, but Kospi up 74 hundredths. Europe, DAX up 64 hundredths, FTC 100 up 9 tenths, Euro stocks 50 up 31 hundredths. Modestly positive, commodities helping the FTC. FX is quiet, USDJPY down 8 hundredths, essentially flat. Euro dollar unchanged, the dollar index down 7 hundredths. No panic flowing in from Asia or Europe. The moving piece is oil, not a systemic yen carry unwind. Still, Japan, CP. Friday is the one to watch. If it pops, that conversation changes. That brings us to the portfolio hot news theme, stagflation and hidden debt. This is the collision of oil, tariffs, and off-balance sheet leverage. And it's the lens I want everyone to apply to the rest of this week. The drivers are stacking. West Texas Intermediate crude sustained above 87, 11 nights of Hormuz strikes, Houthi choke point threat, and now trade policy piling on. Greer yesterday on Squawk Box saying expect action soon on tariffs for dozens of countries. Some existing levies lapsed this Friday. Copper frozen at 14,000 a metric ton because the market has no idea what percentage to price. Then last night, Trump announced phased tariffs on imported generic drugs. 2-year grace period starting August 1st, then 100% tariff by 28, then 200% after that. The stated goal is to force onshoring, but the immediate effect is another layer of cost-push inflation. When you stack trade policy costs on top of oil costs, you get a stagflationary setup that compounds on itself. The bond market is already at 2-month high yields and a 27% hike probability because of oil. Add tariff-driven input cost increases, and you're not just talking energy inflation anymore. You're talking goods inflation across multiple sectors. If oil closes above 88 and Greer follows through with concrete percentages this week, that rate hike probability goes to 50% or higher before the FOMC meeting on the 29th. The bull case for energy and bear case for growth is straightforward. Oil above 88 forces the Fed to stay hawkish. Yields stay elevated. Growth multiples compress. Energy and domestic manufacturers benefit from both the supply premium and tariff protection. The bear case for the thesis is equally clear. A ceasefire or de-escalation drops oil below 86, rate hike fears fade, growth stocks rally sharply, and the stagflation trade unwinds fast. Second-order effects matter. Shipping and insurance costs are rising. Domestic energy producers, that's the energy sector ETF position, capture the premium, and companies with hidden debt, like the 5 tech firms carrying $1.65 trillion in obligations, see servicing costs spike as yields rise. The CapEx language tonight is the tell. If Alphabet or others signal restraint, the hidden debt is already constraining them. TB, your BYD gut call at 87.15 with a stop at 82. That's a tariff avoidance play. Chinese manufacturing outside China. Betting the net catches direct exporters harder than diversified ones. It's tiny, it's flat, but structurally it's tied to this exact theme.
Right. It's a $1,000 position, up 23 cents, 0 for 3 on my closed trades. Not handing out entry advice. But the thesis is that if direct export tariffs rise, companies with manufacturing outside China get a relative advantage. It's a small bet on that divergence. Meanwhile, my wave trader algo timed out this morning. No live positions to report, just the macro read.
There. So 3 forces. Oil, tariffs, hidden debt. All pointing the same direction for bonds and energy. Opposite direction for growth and discretionary. Watch tonight's 4-pack of earnings through that lens and nothing else. Here's what we're watching tomorrow. Number 1. West Texas Intermediate crude close. Above 88, and the bear case accelerates into Thursday's pre-market, no matter what Tesla or Alphabet say. Below 86, and the market breathes. Earnings get to drive. Number 2. After-hours reactions. Google CapEx language. Texas Instruments. Industrial demand. ServiceNow and IBM Enterprise Health. Tesla narrative test. 2 disappointments, plus oil elevated, equals a rough Thursday. Number 3. Friday's tariff deadline. It's an unpriced binary. Greer's action soon could become concrete percentages for dozens of countries overnight. And number 4. Thursday, pre-market is loaded. Raytheon, T-Mobile, Thermo Fisher, UNP, Lockheed Martin, BX, Comcast, FCX, NSC, Honeywell. A heavy morning that will either compound tonight's pressure or relieve it.
That covers it. No filler, just the pivot levels and the events. Good luck today. Trade smart. We'll see everyone back here tomorrow.
Catch you on the flip, trading family. Keep your stops tight and your coffee strong. Out.